When it comes to which options to trade, there's always a lot of choices, and I mean an endless amount. But on a most basic level, when you have to choose between expiration dates, obviously that's a simple to understand. You choose expiration date based on your expectations of how long the move will take, or how long you want the position to be on if the move goes against you. For example, if you bought a call and you expected the item to move up, if you put it on for 30 days, if it went your way, great. If it didn't, it is possible it still goes your way, but after maybe a drop. It could drop, stay low, and only after 30 days, rebouncing it back into the money. So you always want to choose the duration based on the expectations of how long the move is anticipated to take. And you can always add a little bit of safety by going a little bit longer. Most importantly, when it comes to which options to trade, there is always out of the money, at the money, and in the money. Out of the money is something that I don't do often, and I typically shy away from it because you're racing against time. And not only that, you have to have the stock go up so much for you to even get to a break-even level, let aside then go on and make money. Out of the money options typically are attracted to a lot of amateurs because of the idea that you will get paid a lot if you make it, and that is true. But the frequency of how many times you make it is usually very little. So it really boils down to a certain style. You can be always buying out of the money options, and out of 10 trades, you'll probably make one. And that one might probably make it up for all of them, but you've got to have a certain level of patience to be able to go through 8 or 9 losing trades only for one to make it. The reason I don't like that style, because if that one does not make you for all of them, now you have 10 losing trades. Even if it's 2 trades out of 10 that are supposed to make it, I just look at it as it puts too much pressure on 1 or 2 trades out of so many, and that's psychologically very stressful in trading. At the money is in the middle of doing that scenario versus doing in the money. In the money is typically the kind of options that I buy. I usually go about 10 to 20% in the money. The reason I stick to doing in the money is, one, I'm not racing against time. There's very little extrinsic value in the option. Usually the more in the money you go, the less the extrinsic value and the more the intrinsic value. So I try to go 10 to 20% where the extrinsic represent no more than 10% of the entire cost of the option. Also remember, this 10% extrinsic depends heavily on which duration expiration. Now, with weekly options, which did not used to exist back in the days, 10% would be extraordinary, a lot. Typically, the options in the stocks I've been used to trade have been 60 to 90 days. So 10% extrinsic as the cost of the entire option is a relatively good number. The reason I like to do that, because extrinsic is always nicknamed the fee. It's an amount of money that, assuming you hold until expiration, you don't get back. You also don't get it back even when you get the direction right. But that's the cost or the fee you pay to control 100 shares of stock for only 20% of the value. Obviously, you cannot get exactly the same thing as the guy who's holding 100 shares, where you're only paying 20% of the cost of the 100 shares and you're getting the same upside. But usually you get about 90% of the upside, assuming we're on a call option. You get usually around 90% of the up move as the guy who's holding the stock, and only 20% of the downside if the trade happened to be a loser and the stock went down. The reason in the money options also give you an advantage is it does not distort the reality. What does that mean? This is where a lot of people confuse options and lose money on them because of the attraction to how cheap they are. But usually they're looking at out of the money options. You know, you go to buy, let's say, 100 shares of Ford at $10, and you're thinking, okay, I need $1,000. You learn options all of a sudden, and you're saying, oh my God, I can buy 10 contracts. I can get 1,000 shares instead of 100 shares for the same amount of money. The original $1,000 that you needed to buy 100 shares, now you're thinking they get you 1,000 shares. And that might be okay, except that now you're over leveraged. Even though there's no risk here in the sense of getting on a margin call, there's no risk of you owing more than the amount of money you put in. This distorts the reality. If your initial intentions was to buy, let's say, 100 shares for $1,000, assuming we're talking about Ford stock for $10, you should stick to that as a baseline. Now you know options. I wouldn't go out of the money options. I would go in the money, let's say $2, and I would buy probably 2 calls. So I'm basically doubled up on the initial position size that I wanted to buy. So now I have the equivalent of 200 shares via 2 contracts, and I'm only risking about 400 and some change probably if we were talking about the $8 call. The reason this keeps it as a base is it helps you guide around how much money you're going to make if the stock goes up 20% or 30%. It also helps keep your head on the ground in the sense of not get ahead of yourself and buy too much with what is already a larger position and, relatively speaking, safer. Depending on the magnitude of a drop, 2 contracts of an $8 call on a stock that's $10 could potentially be safer than buying the actual stock, because if it goes to $4, you'll be down 600, where with the options you're only down 400. So which options to buy? I would always say 10 to 20% in the money, and the same thing for puts. That keeps you in the beginning, or at least initially as you first learn, it keeps you from over leveraging. It keeps you from racing against time. Remember, when it comes to options, it's 3 D's that you have to get correct. The first one is direction. You have to pick the direction, up or down. The second one is duration. You have to pick in how long is that expected move going to take place, a month, 2 months. And the third one is destination, meaning you've got to pick how high or how low this thing will move. So again, this is called the 3 D's. When you are buying in the money options, you eliminate one of those, which is the destination. You are basically now not having to worry about picking a strike where the stock has to get to it before you make money. For example, if you bought the $12 call and the stock doesn't or does move to $12, but your option expires right there, you actually end up breaking even, maybe even losing money because it did not go past 12. Whereas when you buy the in the money option, if it goes up $2, you'll make probably $1.90, $1.80. 10, 20 cents go out of that for the extrinsic value. The second thing is also the duration. As we mentioned, how long is the expected move to take? When you're not paying so much for extrinsic, you're getting pretty much close to delta 1, which really makes the option duration not very relevant, because your worst case scenario, if the move has not taken place, you just roll the option to the next one. If you got into a 60-day option and the stock didn't move from $10, you just get out of it after 60 days, you close it, and then you roll it again, and the trade gets on and on. To get the 3 D's lined up and guess them correctly is not a very easy task, and in matter of fact, it's not necessarily impossible, but it's very rare to capture them all the time. Thus, you want to try to minimize the guesswork and work around a strategy or a position structure that allows you not to be having to fight against these 3 forces. Thus, by doing it with in the money options, which is the preferred choice that I do, that helps out big time. How far in the money? 10 to 20% is a general rule, but it depends on what you're trading. That obviously could vary.